Okay, welcome to the final for BMGT 424, Advanced Accounting. Spring, how would you like if I taught like that? Spring 2016. Would that be good? Would you like that? Okay, here we go. I'm going to start drinking and smoking. Here we go. Number one, Paul Company owns 25% of the company. This was a very chapter one, simple chapter one question. How much income do they report? Simply 25% of the income, 110 times 25%. Answer D. I don't think anybody got that wrong. Even Robert didn't get it wrong. 27,500. It's amazing. All right, number two, we have none of the answers are correct. Therefore, you had to write in your own answer, and if you wrote in $400,000, go to the head of the class for that problem. You got it right. So 400 was correct there. 400. Even Robert got it right. All right. You got that one wrong? Wow. The grade, you're helping the curve even more than I ever expected. All right, number three was an exact duplicate from the quizzes, I believe. Wasn't it? Wasn't it an exact duplicate?
Besides the journal entry.
Besides the journal entry, right. So the journal entry was a little bit of a twist just to make sure you remember the fact that the goodwill, which is either, you could have said 1.2 million for the whole or 300,000 as for 25%. That's the goodwill. The goodwill as a whole is 1.2 million. How did you get that? Well, I think everybody got that answer, and if you didn't, call me up on my cell phone, which has been changed. As for the journal entry simply was credit to cash, $2.5 million, debit to investment. If you put goodwill somewhere in that journal entry, a couple people did, there was no reason to do that. That's not what happens. That doesn't get done. That would be wrong. In fact, if you got that one wrong, you failed the whole exam, so you might as well not even watch the rest of the video. You're done. Okay, number four, X-Beams, what a name. Owned 70%. And what did they do? They had a sale between the companies. It was a upstream, watch how you say that, Robert, upstream sale. And all you had to do here was the normal figure out what the profit is that has to be unrealized profit, the unrealized gain, which turns out to be $16,000. Because, why? Because that's what it is. Here is how you would do it. You would do sales for you debit the sales using the shortcut method for a minute, 180, credit cost of goods sold for the actual cost of goods sold, 100. That leaves 80 to divide up between cost of goods sold and the inventory, which represents the unrealized profit. 20% of the 80 is 16. So you take 300 minus the 16 to get 284. Then you take your percentage of 30% to get, I believe the answer for that was you were going to get, when you take the percentage, you should get 85,200 as being the amount to the non-controlling interest, because you take the percentage of the total after the subtraction of the unrealized profit. That's the key there. Let's go to the next question, which is number 5. Here, this one is a givey, as it is very simple. Land, sales of land between companies, the general principle is act like the land sale never occurred. So then all you got, I love that. You got to be here. You had to be here. You should have stayed, everybody who's listening to this and didn't stay. This is like a riot where the 25,000 students that came into the room were just laughing like crazy. So so the answer is just take 416, 256, add them together, 672. That's the amount. You act like the sale never happened, so it's the original prices of the land. Bingo, done. Okay. We're having too much fun here today. Number 6. This is, again, an upstream sale. What you have to do is you have to figure out what the non-controlling interest share is by doing the following. Take the non-controlling interest amount of net income, which was reported at 119. Since it used the word reported, you have to assume that means that includes the gain, which was between the companies. The gain was, how much was the gain? $13,000. So you take 119 minus 13. 119 minus 13 equals 106 times the relevant percentage of 30%. And that 30% comes out to 31,800. is the amount reported to the non-controlling interest. Doesn't matter that it's an intercompany sale, the non-controlling interest still reports their share every year as they go along. Okay, that brings us to number, whatever it is, 7 and 8, Clementi. Clementi Company owned stock. What did they do? They sold the equipment. Well, they owned stock. They owned stock of Snyder Company. They had equipment. They sold it to Snyder for $125. Again, the rule, act like the sale never happened. So the sale never happened. So what did they have? They had $140 as the cost. They had $40,000 as the amount of the cumulative depreciation at the time of the sale, which means they had a book value of $100. That book value is getting depreciated over 5 years. So 5 over, or 100 over 5 is $20,000 a year. At the end of the first year, 2012, it means our net book value is now 80. And for number 8, the net book value at the next year will be 60. So it's 80 and 60 are the answers there. We move on. Oh, the whole room is cracking up between Val and Robert. It's like it's amazing. You guys, I have news for you. Since your career is not going to be in accounting, a comedic routine for the two of you would be perfect. All right. Cleary, Wasser, and Nolan. That should be the name of your partnership, by the way. You could borrow that name. I give you permission. Even though it's not your names, it'll work real well. No, private investigators would be good. Cleary, Wasser, and Nolan, private investigators. So here the whole key is to use what it says, using generally accepted accounting principles, which means you have to book up for the capital accounts the fair market value of the investments, which is 100, 150, 200. So you're going to start with 450. You do the math of the amount of money taken out, and you do the math of the amount of profits that were recorded each year by adding the profits, taking out what they withdrew, and you wind up with 708. If anybody needs to see that, again, start with 150, 100, 200, the fair market values, subtract 1,000 a month for 2 years times 3 partners. That's 36,000 a year, 72,000 for the 2 years. That's the subtraction, because that's what withdrawn. The profits increased the capital accounts, and it's simply the addition of the net income 150 and 180 for the 2 years. And it'll come out to 708. End of discussion on that one. Okay. Now we come to the worksheet. The worksheet, we will, let's see. I'm going to address the worksheet in a separate video. So good for you. You get to pick up what are you smoking back there? Could you pass that forward?
I'm 2 for 10 right now, because there's no way I got the worksheet right, because I was 100,000 off.
We'll see. Okay. Here we go. Here's the quiz. Boston Company, a U.S. corporation, sold inventory. They want to know, the question's going to ask, what amount should sales be credited for on December 1st? So it's going to be, since they are dealing in pounds, we have to use the spot rate as of December 1st, which would translate into $17,241, meaning 10,000 pounds will equivocate to that amount of money in cash, so answer D. Then the next question is actually, even though the names changed to protect the innocent corporations, it's the same facts, same spot rates and everything, same dates, and now they're asking what was the result of the balance sheet mark-to-market at December 31. Did we have a gain or loss? Well, it turns out that the dollar weakened because the dollar strengthened, because now for 10,000 pounds you get $18,182 of U.S. money, so the dollar strengthened relative to the pound, so it wound up being a $941 gain, answer E. That's how that worked out. All right, moving right along. The spot rate is, I think everybody did pretty well. My preliminary look at the quiz looks like everybody did pretty well. The spot rate is the exchange rate today, answer B. How are transactions with foreign companies measured in the United States? Answer A, in the U.S. dollars. That's the reporting currency. What is the purpose of a hedge?
What was the last one?
The transactions of foreign companies measured in the United States in U.S. dollars. Answer A. What is the purpose of a hedge? To limit the exchange rate risk. That's answer D. What is a translation loss? Well, A says a payable transaction denominated in a foreign currency causes you to pay more That's a transaction loss. B, a receivable transaction denominated in foreign currency causes you to receive less. That's a transaction loss. So answer C is the correct answer here. Both of those are translation losses, I should say. The answer to the current rate method of the reporting currency is US dollars, USD. And the answer for when the current rate method, or while the current rate method and while the remeasurement method differ, what account will always be on the balance sheet? That was a giveaway. I shouldn't even have said that, probably. But the balance sheet, one account that will always be translated historical is common stock, capital stock, or paid in capital. Any one of those answers would be correct. So that would be common stock. Capital account, that would be probably acceptable as well. Okay, which of the following characteristics is not indicative of an enterprise qualifying as a primary beneficiary? Here it's no ability to make decisions, that's answer D. If you're a primary beneficiary and it's a VIE situation, you have the ability to influence, makes decisions. And the last question, the last possible question of the entire spring semester here, this is it. Drum roll, please, symbols, and the answer here is a VIE cannot take the legal form of a partnership or a corporation. That is false. In fact, it's quite the opposite. It must take the legal form of some type of an entity, with the exception of nonprofits. Sole proprietorships don't qualify for VIEs either. That's it. You should have been here. 25,000 people in this classroom watching this video, and please hold your applause till we're done.